Already, boy, this year has gone fast. Well, without any further delay, let's get right into it. Today, we're going to cover the economic indicators such as the vaccine, labor, tax changes, housing, stock market, inflation, Social Security, finally the retirement plan, and the econ map. Well, let's talk about the virus because that's been the big economic indicator for the last year and a half, going on almost 2 years now. It was first approved December 14th, 2020. Right now, as of July 23rd, we have 187 million doses that have been deployed. Still on track for November. All states would be vaccinated at least at an 80% vaccination rate. Labor, initial claims, good news, continuing unemployment. Claims now down 1.3 million to a total unemployment claim. Now remember, this is not the total number of people that are unemployed. This is just the total number of people that are on unemployment insurance. Some people have expired. Some people have decided not to go back, but it's 12.6 million. And a lot of that is due to the extended removal, the removal of the extended unemployment payments. Down to 12.6 million on unemployment, which gives us the lowest amount since March 2020. Gives us down to 5% unemployment. However, it doesn't really change what's going on within the supply chain. We have 1 out of 4 Americans that are still making more by staying at home than actually going to work. At least 26 states have approved removal of the excess unemployment, which should do well to incentivize those people that want to sit home and play their Xbox, collect free unemployment, as opposed to go actually do what we Americans do best, work for a living. Anyway, inflation, we do have this supply line shortage, and it is creating that creates less supply with increasing demand. And one of the reasons is right now we're sitting on close to $4 trillion in cash. So people want to spend money, but they can't buy those things. Inflation, again, I think it's a temporary issue that's going on because of the supply chain and because people have a lot of money and they're buying things up. Again, it's another repeat of the 1929 crash. Let's move on to taxes, unfortunately. As I stated back in October, November of last year, that we would see a huge increase in taxes, and it's on its way. It's what I'm now calling the middle class estate tax. And one of the reasons is that, originally the proposal was $1 million in annual income increases the gain from 20% to a 43%, but now they're pushing that back to $500,000. And remember, the proposal of that $1 million is really not only while you're alive, but if you die, because then that pushes out all the gains on real estate, stocks, bonds, businesses. The removal of the 1031 exchange, that can be a huge expense. And the removal of the step up in basis. Again, really what the true intent is to snare more lower income and middle class people, because right now the estate tax limit is $22 million. Not everybody, not a lot of people, as a matter of fact, I think it's less than 1% of people actually will pay that type of estate tax. However, when you take away the step up in basis, the 1031 exchange, you compress the payout of a retirement plan, it's going to tax all the middle class. Again, I've said this from day one. I don't believe that the IRS or Congress is really intending to go after the billionaires, because they have a couple $100,000 a year to hire legal counsel, CPAs to fight the IRS. They're going after the $1 to $20 million families. Why? They don't have that kind of budget to fight the IRS, and they're an easier target because they're going to have to, like call uncle. All right, I'm just going to pay you because it's going to cost more to employ the CPAs and the lawyers than it will just to pay the IRS. And the new IRS is on a whole new warpath, right? So we haven't seen this with the IRS for probably 15 to 18 years, but they just got a $5 billion budget, and they're asking for $80 billion more to increase their staff by 40,000 people. Now, of course, that's going to make up for the 20,000 that they lost in the last 3 to 4 years, but it's going to add an additional 20,000 employees. So last year, there was an estimated 5 million audits. They anticipate with this increase, that'll increase the audit rate to 10 million people. So again, we got to watch out for what's coming down the pike. So number one, 4 times the number of audits, increasing their technology capability, and understanding that when you deal with the IRS, it's not necessarily fact. It's a negotiation based upon what they think they can get from you and what you're willing to give up versus going to tax court. Housing update. Well, new housing builds. Well, we're starting to see some leveling off. But again, as I've stated from day one of this entire pandemic, when this housing crashes, I'm going to see a repeat of that 2004 to 2007 crash. I'm now starting to see some estimates that will push this out about 2 years, but it could go in certain regions as high as 40 to 50%. And I really want to make sure that everybody understands the rental income myth. People will say, well, I'm just going to buy a piece of property so that I can have additional income. Look, it's not that easy. You're talking to a guy that's owned 70 rental properties before, and it's a business. You have to treat it like a business. You have to be available. You have to make sure you understand where you're buying, your customers, everything. So rental property is not just as easy as just buying it and renting it to somebody. And if you look at what happened in the last recession where real estate crashed, a lot of that was because of the faulty banking regulations. But look at what's happening right now. I mean, people are just paying an insane amount over the valuation. So again, there's a difference when you buy something for a residence versus if you buy it for an investment. Here, I'll tell you an interesting story. So I have a client, we did a review with them just recently, and they told us about a story of somebody that they knew that was going to buy real estate, and it was up 20, 30%. This is in Las Vegas, and they're going to be buying an $850, call it $900,000 house on a nurse's salary. And this person thought, well, this is what people do, and her comment was, but real estate always goes up. It's a no-lose deal. Now, I don't really know what century this person, what decade this person, or what altered reality that this person is living in, but real estate does not always go up. It depends on what period of time that you look at. If you would have bought real estate in 04, 05, 06, you might have just recovered about a year ago. Just recovered after 15 years or so. So again, it is not based upon, there's a belief that real estate is always there because it's a hard asset that you can see. But again, it depends upon what region, when you buy it, the interest rate, the age of the property, so many factors. Please do not take the impression that real estate is a safe deal. Hey, let's move on to Social Security. Social Security in 2021 only increased by 1.7%, but a recent study just released showed that the Senior Citizens League estimates that 2022 increase will be at 4.7%. Now I've got some flashing news for you, and that news is that the OMB just released that they estimate that Social Security will go up in 2021, meaning you'll get paid in 2022, by up to 6.5%. That will be the historical high that Social Security has ever gone up. The next closest to that was back in 2009 when Social Security went up by 5.8%. But again, when Social Security is measured, if you have a collapse of the economy and a depreciation, that inflation is easier to go up. The good thing about Social Security is if there's deflation, they do not go backwards. Again, I truly believe that this inflationary problem that we see right now, it's just flash inflation. It's a supply chain disruption that will not last, nor will the low interest rates. Now, from the beginning of this pandemic, when I started doing these broadcasts and started playing out the algorithms that we build for our clients, I said that this is going to be a roaring 20. It's going to be the same thing as the 1919 Spanish flu. So we go through that, and look what happens. Virus hits the world. World goes on lockdown. The pandemic fatigue hits. People get sick and tired of staying at home. And then the spending spree hits. Now, here's what's interesting about where we are today compared to 1919, 1920. The spending spree hasn't really even hit yet because of the supply chain disruption. People have the money. As a matter of fact, the government has spent out so much in stimulus money, people are just sitting on scads of money. So we haven't even gotten to that point where it's being spent. Now, once that spending takes hold of human habit, neural pathways are created, and people want to spend money just like they did back then. However, when they run out of money, they go into debt to keep that habit going. When their debt runs out, then just like what they did before, they turn in the stock market. We're already starting to see a little bit of that with meme stocks and things like Bitcoin and gold trading and NFTs, etc. And then what happens? Well, then we have a market meltdown like we did in the 1929 meltdown, where it went down 80, 90%, and it took 15 years just to recover. Now, here's the thing to remember. In 1920s, in the 1929 crash, factuality, there were more millionaires minted per capita in that year than any other time. So don't be worried about the crash. Be concerned and observant on what opportunities open up when it happens. Let's move on to the stock market. If we use the S&P 500 as a broad index, we are sitting as of yesterday at 4367 on the S&P, which we started off the beginning of the year at 3,700 points. So that gives us a 27.42% annualized rate of return year to date. So what do people need to do? They need to recalculate their retirement because you're going to have higher income taxes, higher capital gains taxes. You have to be very careful and strategic upon how you withdraw money, when you withdraw money, and from what accounts you withdraw money from. You have to be careful if you're trying to save into typical IRAs or retirement plans, how the IRS is planning to change the retirement plans from a deduction from contributions to a flat tax credit. That will have a big time change in your future. Also, because now they're going to be applying this middle class estate tax, how do we now treat lifetime gifts? How do we treat RMDs? Because there's a plan right now to increase at age 75. And should we be doing Roth conversions? And most importantly, when? Now, one of the things that I've talked about for years is the difference between what I call the linear plan and the bell curve plan. On the left-hand side of your screen, you'll see what 99.9% of every financial institution and advisor teaches people. They teach people that while they're living, they should inflationary increase their income over a period of time, usually at age 100. And this way, you don't run out of money. I will tell you that the left side that you see where it's linear planning, that's what you will find in almost every financial plan, retirement plan calculation. If you've listened to me for any period of time, you'll know that I'm more of a fan of the bell curve plan. That's on the right-hand side of your screen. That is where you up your spending, increase your spending up until about 78 to 80. Why? This is experience talking over anything else. So for close to 40 years, what I've watched is as people get around 80 to 82 years old, their mobility, their health, and really their energy to be able to travel and enjoy all kinds of activities and hobbies drastically drops. So the question I have for you is, are you on the linear plan or are you on the bell curve plan? Actions to take now. Change portfolio to paradigm shift portfolio strategy. Figure out what the maximum amount that you can spend in your lifetime could be, and it may be a lot more than what you ever thought it would be. At the same time, make sure you understand what your risk is, because you don't want to be taking more risk than you should and have to backtrack later on. You should be refinancing real estate and holding out on any investment real estate purchases for now. Now, if you're with us, we've already moved all your bonds into short terms and into tips, but you should not be holding any intermediate term or long-term bonds at this point. And you should also look at rebalancing and a recalculation of the maximum amount that you can spend during your lifetime. Hey, before we wrap it up, I'm going to give you my famous econ map. This is something that I have followed for close to 30 some years. I learned it from the firm that I was in. And so far, right now, if you watch what's happening, and this is version 7, we created the version 1 back in March of 2020. And so far, we're still hitting about 85% accuracy. So 2020, the virus hits, right? March, everything starts to shut down. We anticipated that real estate was going to take a dip. It moved forward because of the rent forbearance, the foreclosure forbearance, and the lowering of interest rates. So we anticipated a high increase in real estate, but we anticipate that first quarter of next year to second quarter of next year to drop and then level out. This is the perfect opportunity and the time to buy things. And we anticipate right now there's still about 2 million mortgages that are in forbearance. We don't know what that filter out effect will be, but it's still going to have an impact. Unemployment. Well, we anticipated employment was going to soar off the map as the virus came out. People had pandemic fatigue and people just wanted to get back to spending, and that has happened too. So the other point is I want to make sure you understand is taxes are going to have a huge, huge impact, but I do not anticipate them affecting any stock markets or any real estate markets until first quarter to second quarter of next year. But you still got to plan on it. And the stock market, again, I do not plan any downside to that until the middle of next year. Hey, that's it for today's show. If you want to subscribe to my YouTube channel, just all you got to do is Google H&H Retirement on YouTube. You're going to get this pretty little page see in front of you here. All you got to do is hit the red button on the top right. It will subscribe you, and you will get notified anytime a new video is popped up on there. Now, if you have any questions or you want to talk to a financial planner or any type of advisor within our office, whether it comes to taxes, legal documents, your retirement plan, just give our office a call. Somebody will schedule something for you. It's 844-702-1040. It's Ken Himmler. Enjoy your weekend.